couple of things that we're going to focus on. One is how can we help you grow your wealth more rapidly? We are wealth acceleration experts at Axiom Wealth. We focus on those critical aspects of your financial life that make a difference. I think the key topics today that are relevant are we have a new administration, we have a new tax plan. What does the tax landscape look like for 2025 and beyond? And what strategies are working today to control the cost of taxation? I'm going to kind of walk you through that. And then we've been in a very volatile economic environment, really starting in the third quarter of 2024 and now extending into 2025 with the tariffs. What investment strategies do we see that are really performing well in a volatile environment? What investment strategies are designed to prosper during economic turmoil, during corrective environments? What investment strategies offer counter-correlated performance when we find corrections? So I'm going to talk a lot about those strategies that we see actually helping you continue to grow your wealth more rapidly. Of course, my background is in accounting. I've been a practicing CPA for nearly 30 years. I started my career at Ernst & Young back in the 80s, worked there about a decade, then made some observations about how people typically get underserved by their team of financial professionals, and in particular, their CPAs. The one thing that I observed about my profession is so many of us are historians. We tell you how much money you make, how much you owe, when and where to file your taxes, and oftentimes how to write some very large checks at the last minute when you least expect it. I formed my firm over 20 years ago for the sole purpose of helping clients recover dollars they unnecessarily pay in the form of state and federal income taxes, and built a very successful boutique CPA firm simply doing what others don't. Then after practicing for about 20 years and having counted people's wealth for the better part of my financial life, realized there were certain ways that my most successful clients grew their wealth more rapidly than others. And the big takeaway that I made from counting people's wealth was my most successful clients did not put all of their capital in stocks, bonds, mutual funds, and ETFs. So we pivoted our business model to be more of a wealth acceleration expert, focusing on controlling the cost of taxation and finding ways to improve investment performance. I realized that there are four keys to growing your wealth. Those four keys are how much money you make, how much you save, how much you pay in taxes, and how well your investments perform. What we do here at Axiom is we focus on the 80% that matters. 80% of your ability to grow your wealth more rapidly is dependent upon two factors: how much you pay in taxes and how well your investments perform. So what we do is leverage those two issues in your financial life with the sole purpose of driving back either your retirement target date or the date in your life where you become financial free, and you can have less reliance upon the income you earn from the profession you practice, the business you own, or simply however else you're earning your income. When it comes to taxation, we have the Trump administration back in office again. And if you kind of look at what's happened legislatively, the Trump tax cuts from 2017 are sunsetting at the end of 2025. Otherwise, if any legislation doesn't come into effect, they're gone. There is legislation currently in the Congress right now to permanently extend the Trump tax cuts, which we expect to happen. The big thing that we see happening that's going to benefit so many taxpayers in America is restoration of 100% bonus depreciation, where you can write off equipment purchases, cars that meet certain requirements 100% in the first year. Bonus depreciation was down to 60% last year. We're going to get 100% back for 2025. That's going to create a lot of opportunities. And in particular, it's going to benefit one strategy very much that came out of the Biden administration, which I'm going to talk about today. As part of the Trump tax plan, Social Security income and tips are going to be exempt from taxation. And we're going to get a restoration of the state tax deduction, which will benefit most Americans. The other big news from a taxation perspective is we are going to see a massive reduction in IRS funding. The IRS workforce is going to shrink by about 40%. Over the last 2 years, as a result of the Biden administration actions, we saw a massive increase in hiring. We already saw an increasement in enforcement. Audits are being dropped, cases are being closed. So I think we're going to be in an environment very different than we have been in the last couple of years with the Biden administration with a reduction in enforcement. For the better part of a 25 to 30-year career of work, I have helped clients reduce the cost of taxation. If you look statistically at how I've helped people over a career of work, on average, I'm able to carve out about 30% in savings from most of my clients' income tax liabilities. I call that a lifetime annuity of savings. Once you generate the savings, typically in the first year, you're able to use those strategies year in and year out, tweak them at the end of the calendar year, and get massive savings, which ultimately allow you to grow your wealth more rapidly. How do I, as a tax planner, do what other CPAs don't? Well, it's not rocket science. It's simply I take the time to develop strategies using the code to your advantage. I call it playing tax chess. I simply move the pieces on the board in a way that benefit you rather than the government. And the problem with most CPAs is we get so busy with compliance activities. We ask for your information after the close of the calendar year. We prepare the forms, and you get no advice or guidance, and you simply pay the bottom line on that 1040. It comes off the top. You don't realize it, but the reality is almost everyone is leaving money on the table. How do I go about engineering a tax strategy? I start by reviewing your most recently filed business and income tax returns. I look at what entity structures you are using in your financial life. Entity structures, limited liability companies, partnerships, LLCs, they all provide the foundation to control tax. Entity structures each have unique tax attributes. What we do is fit those tax attributes with each entity type favorably to what is going on in your life from a business and an investment perspective. Bottom line is entities allow you to reduce the cost of taxation when used appropriately. How you take money out of your business or your investments, I call it compensation planning, controls how those dollars are taxed. So I go through your 1040 and we figure out what capital that you need on an annual basis to live off of. We volunteer to pay tax on the cash flow that you need. We structure that in the most efficient way. And then we take every dollar of additional income that you don't need to live on and move that into an environment through compensation planning that allows you to avoid taxation or defer or potentially eliminate it. And then we ask ourselves is, what types of expenses are you paying for that maybe if structured correctly could be tax deductible? How can I pay for certain things with pre-tax money rather than post-tax money? And this process, I've been doing it for years and years and years. In about 30 minutes of time, I can go through your 1040s and your business tax returns and actually quantify to the dollar how much I can save you. And everyone on this call is going to get an opportunity at the end, if you stay on, to have a complimentary analysis where I can walk you through exactly how I can help you from a taxation perspective. What happens by going through this planning process and reviewing those tax returns is, one, we simply lower your income tax liability. Two, we end up lowering your chances of being selected for audit. And ultimately, we end up enjoying a high level of protection for the hard-earned equity in your financial life. One of the things that came out of the Biden administration, if you remember the campaign promises when the Bidens were running for the presidency, is they talked about replacing all fossil fuel-based energy systems with green energy technology. And what they implemented as a result of the Inflation Reduction Act of 2022 were massive tax and economic incentives for investments in green energy technology. And the one sector in the green energy technology space that benefited most was commercial solar. So what the Biden administration did with the Inflation Reduction Act was implement two very powerful tax incentives that almost every American can take advantage of. Investments in green energy technology, and in particular, commercial solar projects, allow you in the first year and a half to 2 years to recover up to 130% of your income tax liability, and over a 5-year period that grows to north of 200%. So think about it. I have an income tax liability at the bottom of my 1040. That is an expense. I never see it again. If, however, I put money into a green energy technology project, I move that from an expense to an asset on my balance sheet that immediately allows me to recover that income tax obligation. The two major tax benefits that came out of this legislation are an investment tax credit that ranges between 40 and 60% of your first year investment, and this year, 100% bonus depreciation. So you get 100% write off of the investment in year one, plus a very large investment tax credit, which is a direct write off to your income tax liability. And then you get a 20 to 30-year cash flow based upon the useful life of the green energy technology equipment. And you can sell the investment after 5 years without any recoupment of the income tax benefits. Here is an example. This assumes that I have a $200,000 income tax liability. So I'm going to put $200,000 into a commercial solar project. My basis for tax purposes, if you include the debt in the project, is going to be about $361,000. I'm going to get a federal income tax benefit associated with the depreciation of about $87,000. And I'm going to get an investment tax credit in the first year and a half of $144,500. And I'm going to get annual cash flow in year one of $2,100. So in year one, I put $200,000 out and I get $233,000 back in income tax benefits from the US Treasury immediately. And over a 25 to 30-year period of time, I continue to receive my economic benefits associated with the cash flow, and I get some carry-on income tax benefits between years 3 and year 6. This is a program that millions and millions of Americans have been taking advantage of since 2022. We have access to 3 or 4 providers that have these projects available to everyone. I encourage everyone who has, say, an income tax liability north of $100,000 to look at this program as a potential cost savings measure. One of the things that I like to do when I'm putting together a tax mitigation strategy for my clients is figure out a way to create tax-free income and wealth for my entire lifetime. Most people do a very good job of creating after-tax wealth and tax-deferred wealth through their retirement accounts like IRAs and 401ks, but many people fail to find ways to create tax-free wealth through their Roth IRA. I am an expert at helping clients maximize the value of the Roth IRA in your financial life. And I can do this regardless of how much money you make, regardless of whether you're capped out in terms of making a contribution to a Roth IRA. We have ways to accelerate the way you grow your Roth IRA. The Roth IRA for every American is probably the most valuable wealth acceleration tool when used appropriately. Peter Thiel, who founded PayPal, used this strategy brilliantly. He contributed about $1,700 to a self-directed Roth IRA and bought 1.7 million shares of PayPal before it went public. PayPal went public, share price rose to $50 per share. His Roth IRA grew essentially exponentially to north of $50 million. And then Peter Thiel goes about investing in other startups and ultimately creates $1 billion Roth IRA. We have a version of this strategy that will work for every American using self-directed retirement accounts. I call it the preferred investment partnership. Many of you who are with the IRA Club have checkbook control IRAs. The preferred investment partnership is almost identical to a checkbook control IRA, with the exception is that it has an operating agreement with a unique waterfall that benefits growth in the IRA on high-performing investments. And this particular checkbook control IRA has 2 classes of membership, what we call a Class A and a Class B member. The big picture is this preferred investment partnership or variation of the checkbook control IRA allows you to accelerate growth in a Roth IRA when you have high-performing investments. This strategy couples assets in a traditional tax-deferred retirement account with a Roth IRA account. The strategy limits the growth of the traditional retirement account, which is tax-deferred, and potentially on high performing investments doubles the size of your Roth IRA annually. This is a very, very powerful wealth acceleration strategy. The way the LLC gets set up is just like every other checkbook control IRA. You set up a partnership, you set up an LLC, it gets taxed as a partnership, you roll your IRA assets into the bank account for the LLC. The assets in the bank account for the LLC get invested in your investment. The LLC has a Class A share, which is owned by your traditional retirement account, and it has a Class B share that is owned by your Roth IRA.
Many of our clients have heard me say, Charlie, in the past, be careful of checkbook IRA LLCs because we see firsthand here as the administrator how many people do screw them up. In this case, IRA Club clients, if you're listening, Charlie is helping you or better yet, hand holding you through this process, this team. So he is the one that's actually setting this up on your behalf. His team does. So I feel a little bit more comfortable, correct me if I'm wrong, Charlie, with the setup of the checkbook IRA LLC with Axiom Wealth and your team because you are helping the client through the process, right?
Look, we do everything from A to Z in terms of setting this up. And I will tell you, historically, the most challenging aspect of this setup has been getting a bank account opened. And now we have the opportunity, which I just found out prior to this call, that the bank account for this entity can be housed at the IRA Club. So all of my clients are going to move their bank accounts over to the IRA Club so they can be managed there. That really will help expedite the process, help expedite the deployment of capital into the appropriate investments. And here's how the structure works. Your Class A shares are owned by your traditional retirement plan, which can be an IRA, a 401k, a solo 401k, a SEP or simple IRA, or even possibly a cash balance pension plan. The Class B owner of the LLC is always a Roth IRA or a 401k IRA. When we fund the LLC, 90% of the total capital comes from your tax deferred account and 10% of the capital comes from your Roth. So to make this structure work, you need a small amount of capital in proportion to the total capital from the Roth. And there are a number of ways, if you don't currently have a Roth IRA, to find and get 10% of the capital into that type of an account. In terms of funding the Roth IRA component to this LLC, we can do a direct rollover from either a 401k Roth IRA or a regular Roth IRA. We can do a conversion of your traditional account to make that 10% proportional capital contribution work, or possibly an annual contribution. Any number of ways. The big point I want to make is everyone has the opportunity to set this structure up, regardless of whether you have a Roth IRA today, regardless of whether or how much money you earn annually. This is the magic of the allocation of the earnings in the LLC. So the LLC that has the retirement plan capital from the traditional account and the Roth IRA account goes out and makes its investments. And then at the end of the year, we allocate the earnings between the traditional plan and the Roth IRA. The first 4% fixed rate of return on the entire capital in this structure goes back to the traditional account. The traditional retirement plan does not earn any more than the first 4%. Everything above that first 4% rate of return, for the most part, goes tax-free to your Roth IRA. So on a high-performing investment above 4%, the excess above that 4% goes into the Roth IRA. And here is an example of how this structure actually works and how it benefits you. This assumes I've got $1 million of total capital. I've got $900,000 in my traditional retirement plan, and I've got $100,000 in my Roth IRA. That money goes into this preferred investment partnership in the bank account at the IRA Club and then gets invested. And I assume that I can earn 18% per annum. At the end of year one, my Roth IRA grows from $100,000 to $240,000 because 14 of the 18% annualized rate of return goes tax-free to the Roth IRA. So this doubles the size of the Roth IRA, as you can see. By year 5, my Roth IRA in the structure goes to 1.1 million and then nearly 3.4 million by year 10. Think of the tax-free cash flow that this Roth IRA can spit off to you on an annualized basis. It's game changing. If you invested without this structure, just using a regular checkbook IRA, at the end of the 5th year, your Roth IRA would only have about $250,000 compared to 1.1 million. By year 10, your Roth IRA in a traditional checkbook control LLC would have $523,000 compared to 3.3. This strategy has a place in everyone's financial life that can find high performing investments. Last year, I spoke about that strategy. I had about I had about 18 clients implement that strategy. And every one of the clients that implemented that strategy invested their capital in my hedging and currency fund, my 12X Wealth Trading Strategies fund that is on Investors Row, and they doubled their money. Every single client that put this structure in place last year and that put capital in the 12X platform doubled their money in their Roth IRA. Let me back up here. So we're going to fund the LLC with $1 million. 900,000 of the million is going to come from my traditional IRA account. 100,000 is going to come from my Roth IRA. In the first year, I'm going to earn 18%. If you're in my 12X fund, that's what you're going to earn. So the earnings in year 1 total in the LLC, $180,000. The first 4% of that 18 goes back to my traditional IRA. So 4% of $1 million is 40,000. So my traditional retirement plan grows from 900,000 to 940. The excess rate of return above 4%, which in this case is 14%. So 14% of $1 million is 140,000. My Roth IRA starts with $100,000 of capital. It earns 140 from the investment in year 1 and grows to a total of $240,000. That's how this structure works. This is the magic behind the preferred investment partnership. For 225 weeks, that fund has been in existence, and it generates in a retirement plan, if you compound your earnings quarterly, actually up to 19.9%. When I first started the presentation out, I talked a little bit about the focus on the 80% that matters. Of course, I talked a little bit about taxation and how we control that cost in your financial life. But the other big piece and the biggest mistake that I see so many people make is they put all their money in stocks, bonds, mutual funds, and ETFs. And at best, they grow their wealth at a modest rate over a career of work, I'd say 6 to 8%. Then we get into these environments like we did with the tariffs, where we have major corrections, other events that happen that bring down the value of our portfolio. We advocate a 3-legged stool approach to allocating capital, where you have some money in financials, some money in passive investment real estate, and some money in alternatives. And what we believe right now is very important is the alternative investment class in the economic environment that we're in today. This is a comparison of how the 3-legged stool has performed against the S&P 500 over the last 5 years. What you see is the light blue line at the bottom is the average performance in individual portfolios, assuming they have a 60-40 blended portfolio between equities and fixed income investments. Most clients do not meet or beat the index because they have a financial advisor that gets paid advisory fees, and typically their allocation is not as efficient as the index. The index is the black line, typically performing better than most Americans' overall financial performance in the markets. The blue line is the performance of the 3-legged stool. Some capital in financials, some in real estate, and some in alternatives. And what we saw is kind of at the back end or the beginning of 2022, rising interest rates, prolonged inflation, saw market corrections, but the 3-legged stool offered counter-correlated performance and performed well during corrective market environments. That is the secret to investing. What is working well today? I call it the hidden strength of alternative investments. Why do alternative investments have a place in your portfolio? One is they're not priced daily and not subject to the roller coaster swings that we experienced starting back in August of 2024 and now more recently as a result of these tariffs. You have extended lockup periods that kind of reduce the risk of panic driven decisions. Should I sell now? Should I get out of the market? Should I take my capital and put it in money market accounts? When should I deploy capital? You have the ability in alternative investment strategies to perform well in strategies that are designed to benefit from market volatility. I'm going to talk about a couple of strategies that do very, very well in economic periods where we have volatility either in an upward or a downward direction. Alternative investments offer the ability as well because oftentimes private equity and hedge funds have a lot of capital sitting on the sides. They have the ability to seize attractive entry points from a valuation perspective, unlike your traditional financial model where you've got money invested passively. It's in the market, it's stuck there. You're investing for the long term, and you don't have the ability to seize points in time where you can take advantage of corrective environments. I believe investments in two primary spaces offer the opportunity or the potential to generate outsized returns in today's environment. One in private credit, asset-backed lending, and the other in indexed and currency hedging.
Let me tell you the story behind 12X. About 7 years ago, I had a client that was a commercial real estate developer from Montreal, Canada, that did a fair amount of development work in Chicago. I did all his US-based tax planning for the better part of 20 years. He comes to me and says, I've got an individual as a family member that was trained for 7 years by the individual that runs the Forex desk at Goldman Sachs. And he's been trading friends and family accounts for the better part of a year and a half and grew an account from $800,000 to $3.8 million over that 18-month period of time. And I said, too good to be true, got lucky, once off, probably not stable or predictable, but I had the fortitude to fly to Chicago, Illinois, and got the 18 months worth of trading reports, met the trader, brought him back to Dallas, Texas, and gave those trading reports to an individual who was doing tax planning work. His name was Surjit Kaur. He was a managing partner at PricewaterhouseCoopers, had a PhD in aerospace engineering, was retiring early at age 47 from doing Fortune 50 consultant. And I said to him, hey, Surjit, you're a rocket scientist. Tell me every reason why we shouldn't get involved in this strategy. Comes back to me 6 weeks later and said, Charlie, what I found is stable, predictable, and not volatile, and you and I should put some capital with the trader. And we did. We each put $200,000 with the trader, gave him very specific instructions on what he could trade, percentage of capital he could trade. But in the 18-month period of time, we did not have 1 week with a net loss, and our gross annualized returns were right at 42%. And that's now about 5 years ago. And at that point in time, we set up a fund structure, really initially for my inner circle clients to participate in, to have access to this, and ultimately made it more broadly available and now offer it on a wider basis to accredited investors. And essentially what we do is we trade 6 major currency pairs, and we trade them in the London Exchange and in the New York Exchange. And that fund has grown from its infancy to over $130 million of capital under management. And in the 5-year history of this fund structure, we have had 1 week with a net loss. This chart here shows the trading performance on a weekly basis since the inception of the fund through the end of 2024. And what you see is there's gaps in time where we don't trade at all. Some periods of time when market conditions aren't favorable, we don't trade. What is unique about this fund is it benefits and produces the highest level of profitability during periods of high volatility. The more volatile the economic environment, the better the performance. So this is one of those unique strategies that is designed to capitalize on market movement, either in an upward direction or a downward direction. And Over the history of all of my investing, I've never seen a structure or an investment that performs at this level consistently over time. You think about it, back into the COVID crisis, prolonged inflation, rising interest rates, now the most recent events with the Trump being reelected and the August 2024 1,200 market point drop, and then more recently with these tariffs. So this strategy is something that generates outsized returns. Here's the statistics that are important. 77% of the trades win, about 30% of the trades lose, 22%, 23%. The size of the winning trades, however, are much larger than the size of the losing trades, a 7.8% variation between winning trade size and losing trade size. 225 weeks of winning trades with 1 week of net loss. And we only trade 3% of the capital at most in any one trade, with no more than 4 trades out per week. So at most, 12% of the capital is exposed to the market. In terms of fund economics, this fund pays out quarterly earnings. The fund term is anywhere between 1 and 3 years. You commit for 1 year, and then you renew annually thereafter. Minimum investment is $100,000. And what is great about this strategy is if you're at, say, my stage in life where you're thinking about translating your financial equity into cash flow, this fund generates a fixed preferred return ranging between 16.5 and 18.5%. Earnings, if they're not taken out, are compounded quarterly, which means your overall rate of return is close to 19.5% when you're compounding quarterly. There are no fees, there are no commissions, there's no sales charges, no AUM fees. We keep the excess rate of return above and beyond what investors receive. So we, as sponsors, are very much aligned. I love this strategy. It is a core holding in my personal portfolio. I think it has a lot of benefit in everyone's portfolio in today's economic environment. I am also a big believer of asset-backed lending. We sponsor 2 lending funds, one in real estate and one in entertainment. The goals on our lending funds are to target double-digit rates of return. Most lending funds, because you're only earning an interest rate, are charging, say, 10 to 12% interest rates on the capital they have deployed. We have a very unique model that allows us to potentially get into higher double-digit return rates of return. There are no fees in any of our lending funds. Most lending funds charge a 2% fee. The tax treatment on a lending fund is passive. The income is passive, which is the most favored form of income for a taxpayer. Debt has a much lower risk profile than equity investments. The one asset class in the market that has gotten beaten up over the last 5 years is fixed income investments. If you've had investments in corporate bonds, treasury bills, money markets, at most you're earning 4 to 5%. Equity asset-backed lending has the ability potentially to double or triple your fixed income rate of return. Most people over the last 5 years are lucky to have what they have in a fixed income investment today that they had 5 years ago. The lending fund also is very liquid. It offers the ability to generate immediate high yields and immediate cash flow on a quarterly basis. And typically these funds have very short lockup periods of between 12 and 24 months. We have a fund called the GP Leverage Real Estate. It's a lot like most real estate funds, but we have a twist. We lend our money out at, say, between 12 and 14% with a 2 to 3% origination fee, but we take a general partnership interest in every loan that we make. So if a loan or the underlying project performs well, we earn a share of the profits. That strategy of having low exposure to the equity or the general partnership side of the loan allows us to earn potentially outsized rates of return. We lend predominantly in Texas and Southwest Florida. Most of the borrowers are real estate clients of mine that I've developed over a 25-year practice as a CPA. So I know them, I do their tax returns, I see how they perform. We lend to people, we know their business models. In terms of exposure to risk, debt has the lowest exposure to risk. Okay, most rates of return on debt in an asset-backed real estate fund are going to earn between 10 and 12%. Your limited partners are next up the risk pyramid. Limited partners are typically going to want to earn about 20% on their capital. The most risky capital stack is the general partnership interest. General partners in a real estate transaction look to earn 30 to 40% on their money. So what we do is we have an 80-20 exposure. 80% to the lowest risk profile in a lending transaction and a small 20% exposure to a general partnership interest. Worst case, we're going to get our money back on the debt. Best case, we're going to earn a nice profit share on the underlying transaction when it performs well. And that has allowed us to create double-digit rates of return in our real estate lending fund. Last year, that fund did 15.1%. We did $11.3 million in loans across a total of 34 transactions. No defaults, no losses. We lend out at an average of 60% LTV, which is appropriate in today's real estate economy. Some lending funds do 75 to 80. We're at 60, and our loans on average are no more than 4.5%. 4.5 months. The best way for people to get hold of us and to learn how we can help them is to reach out to us at our website, www.axiomwealth.com. That is www.axiomwealth.com.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.